January 1980. Silver hits $50 per ounce. Two brothers from Texas controlled 1/3 of the world's deliverable silver. Not stock certificates, not paper contracts. Physical silver, bars stacked in warehouses across 3 continents. Their position was worth $4.5 billion, equivalent to $17 billion today. They weren't bankers. They weren't traders. They were oil billionaires who decided the silver market was too small to resist them. And for 18 months, they were right. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, executed the most audacious commodity corner in modern history. They bought silver. They stored silver. They convinced wealthy Arabs to buy silver. They took delivery of every silver contract they could touch. Tiffany Co took out full-page newspaper ads, blaming them for skyrocketing silver prices. Jewelers couldn't afford inventory. Industrial manufacturers faced shutdown. The US government watched nervously as 2 private citizens destabilized a critical commodity market. But what nobody knows is how close they came to actually pulling it off. The plan wasn't just to make money. The Hunt brothers believed the US dollar would collapse. They saw inflation ravaging the economy under President Carter. They watched gold shatter records. And they calculated that silver, industrial, monetary, and scarce, was criminally undervalued. So they didn't just invest in silver, they tried to own it all. For a brief moment, they succeeded. Then came Silver Thursday, March 27, 1980. The day the Hunt brothers' empire imploded. The day silver crashed from 50 to 10. The day that nearly brought down the entire US financial system. Major brokerage houses faced bankruptcy. The Federal Reserve prepared emergency interventions. Wall Street held its breath. This is the story of how 2 Texas oilmen almost broke the global silver market. How they exploited every loophole in commodity trading regulations. How they recruited Middle Eastern royalty into their scheme. And how their spectacular failure changed financial regulation forever. This is the Hunt brothers' Silver Corner. The Hunt family ended up as cautionary tale subjects in every business school in America. Their silver gambit resulted in a $1.7 billion bailout, federal investigations, and convictions for market manipulation. But the story starts decades earlier, in a very different Texas. Haroldson Lafayette Hunt Sr., H.L. Hunt, struck oil in East Texas during the 1930s. Not a lucky well, an empire. By the 1950s, he was reportedly the richest man in America. When he died in 1974, he left behind an estimated $2 to $3 billion fortune, 15 children from 3 simultaneous families, and a corporate structure so complex his heirs spent years untangling it. Nelson Bunker Hunt and William Herbert Hunt were sons from H.L.'s first marriage. Bunker, born in 1926, was methodical and obsessed with commodities. Herbert, born in 1929, was the more cautious brother who followed Bunker's lead. They inherited significant chunks of the Hunt oil empire, but operated semi-independently from their father's original company. What most people don't know is that the Hunt brothers weren't reckless cowboys. Bunker Hunt had already executed one of the most successful commodity plays in history, the Libyan oil concessions. In the 1960s, he secured drilling rights in Libya and discovered the Sara oil field, one of the largest in Africa. At its peak, the field produced 450,000 barrels per day and generated hundreds of millions in annual revenue. Then, in 1973, Libyan dictator Muammar Gaddafi nationalized Bunker's oil fields. Gone. Bunker lost an estimated $2 billion in future revenue. No compensation, no negotiation. One day he controlled a massive oil empire in Libya. The next day, nothing. This wasn't just about money, it was about power and trust in government systems. Bunker Hunt watched a sovereign nation confiscate his life's work. He watched the US government do nothing to help him, and he drew conclusions about the stability of paper assets, government promises, and fiat currency. Behind the Hunt brothers' silver obsession was this profound distrust. They believed governments couldn't be trusted with monetary policy. They watched President Nixon abandon the gold standard in 1971. They watched inflation accelerate throughout the 1970s. They watched the Iranian Revolution in 1979 spike oil prices. Chapter 1. Texas Oil. The Hunt family wealth didn't start with silver. It started with one of the most dramatic oil strikes in American history. H.L. Hunt arrived in East Texas in 1930 with a wildcatter's instincts and a poker player's nerve. The Depression had devastated oil prices, but H.L. saw opportunity. He heard rumors of a massive oil field near Kilgore, Texas, the kind of discovery that could make or break fortunes. The key was a driller named Columbus Dad Joyner, who had struck oil on a small tract of land. Joyner knew he'd hit something significant, but he was broke, exhausted, and overwhelmed. H.L. Hunt recognized what Joyner didn't. This wasn't just another well. This was the East Texas oil field, which would become the largest oil field ever discovered in the contiguous United States. Hunt bought Joyner's leases for $1.3 million, paid mostly in promissory notes, and suddenly controlled access to billions of barrels of oil. The East Texas field would ultimately produce over 5 billion barrels of oil. Hunt's timing, his willingness to take massive debt-financed risk, and his ability to negotiate under pressure created a family empire. By the time Bunker and Herbert were teenagers, the Hunt family was synonymous with Texas oil wealth. But H.L. Hunt wasn't just an oilman. He was a political ideologue who believed in hard money, limited government, and the inherent instability of paper currency. He published political newsletters, funded conservative causes, and preached that gold and silver were the only true stores of value. This ideology soaked into his sons. Bunker Hunt absorbed his father's distrust of government and his conviction that commodities represented real wealth. While other wealthy heirs partied or pursued genteel hobbies, Bunker studied commodity markets. He read about historical corners, attempts by wealthy individuals to dominate markets. He studied the Hunt brothers' attempt to corner wheat in 1898, the Stutz Motor Corner of 1920, and other dramatic market manipulations. You see, Bunker Hunt wasn't satisfied managing his inheritance. He wanted to prove himself, and he wanted to do it in a way that validated his father's monetary philosophy. His first major independent move was the Libyan oil gambit. In 1957, Libya opened bidding for oil exploration concessions. Major oil companies focused on the most obvious prospects near known fields. Bunker Hunt studied geology reports and took a contrarian bet on Block 65 in the Libyan desert, far from proven reserves and considered a long shot. He was spectacularly right. In 1961, Hunt Oil discovered the Saria field, estimated at 12 billion barrels of recoverable oil. Within a few years, Bunker's Libyan operations were producing hundreds of thousands of barrels daily. The profits were staggering. Bunker became a billionaire in his own right, independent of his father's fortune. But here's what's interesting. Bunker Hunt's success made him more vulnerable, not less. He had proven he could identify undervalued opportunities and execute long-term strategies. He had demonstrated the patience to develop a major oil field over years, and he had created a fortune that existed almost entirely in a foreign country, dependent on the goodwill of an unstable government. Herbert Hunt, 3 years younger, played a supporting role in the Libyan venture. Where Bunker was aggressive and visionary, Herbert was analytical and detail-oriented. They complemented each other. Bunker identified opportunities. Herbert managed operations. Together, they built a formidable partnership. The Hunt brothers' oil wealth gave them something unique: enormous cash flow from producing wells. Unlike investors who needed to liquidate assets to fund new ventures, the Hunts had hundreds of millions of dollars flowing in annually. This cash became the engine for their later commodity speculation. Throughout the 1960s, the Hunt brothers diversified. They invested in real estate, agriculture, and food processing. They owned ranches, office buildings, and food companies, but they always returned to commodities. Bunker believed commodity markets were the purest form of capitalism, supply and demand, without the distortions of government intervention. I mean, Bunker Hunt genuinely believed he understood commodity markets better than anyone else. His success in Libya wasn't luck, it was vision. And if he could identify an undervalued oil field in the Libyan desert, why couldn't he identify an undervalued commodity in global markets? By the early 1970s, Bunker was actively looking for the next big play. He watched gold prices rise after Nixon closed the gold window in 1971. He studied silver's industrial applications. He calculated that global silver production was barely keeping pace with industrial consumption. And he noticed something critical. The above-ground stockpiles of silver had been declining for decades. Silver had been used as currency throughout history. But after World War II, industrial demand exploded. Photography required silver for film. Electronics required silver for conductors. Solar panels, medical applications, mirrors. Silver had hundreds of industrial uses that created permanent consumption, not just hoarding. Bunker's analysis suggested silver was fundamentally undervalued. If industrial demand continued growing, while mine production stayed flat. Chapter 2. Silver Obsession. Understanding why the Hunt brothers chose silver requires understanding the commodity itself. Silver isn't just a precious metal. It's an industrial metal with unique properties. It has the highest electrical conductivity of any element. It has the highest thermal conductivity. It's reflective, antimicrobial, and ductile. These properties make silver irreplaceable in hundreds of industrial applications. In the 1970s, the largest industrial use for silver was photography. Every roll of film, every photograph, every X-ray used silver compounds that were consumed in the development process. Kodak alone used approximately 50 million ounces of silver annually. As photography expanded globally, silver consumption grew. But here's what made silver interesting to speculators. The above-ground supply was shrinking. Throughout history, billions of ounces of silver had been mined and used as currency. But after governments abandoned silver coinage in the 1960s, much of that historical silver stock had been consumed by industrial use. The US had stopped minting silver quarters and dimes in 1965. India had sold off massive silver reserves in the 1960s and 1970s. The strategic stockpiles were being depleted. Bunker Hunt studied these trends obsessively. He commissioned research reports. He met with mining executives. He analyzed supply and demand projections from every major forecasting service. And his conclusion was simple: the world was running out of readily available silver. Annual mine production in the 1970s was approximately 250–300 million ounces. Industrial consumption was roughly equal to production, meaning there was little surplus silver entering the market. Most of the tradable silver came from scrap recycling, government sales, or existing stockpiles, all sources that were finite and declining. Look, if you believed inflation would continue accelerating, and in 1973 that was a reasonable assumption, then precious metals had to rise. Gold was the obvious play, but gold had already jumped from $35 to $120 per ounce. Silver was still trading around $2. The gold-to-silver ratio was about 60.1, far above its historical average of 15.1 to 20.1. Bunker Hunt's thesis was that silver would eventually revert toward its historical relationship with gold. If gold hit $200, silver should trade at $10 or more. If gold hit $500, silver could reach $25. The upside was staggering compared to the downside risk. But Bunker didn't just want to trade silver. He wanted to own it. This distinction is critical. Most commodity traders never take delivery of physical goods. They trade futures contracts, agreements to buy or sell commodities at future dates. When contracts expire, traders either roll them forward or settle in cash. Physical delivery is rare, inconvenient, and expensive. The Hunt brothers did the opposite. They bought futures contracts and demanded delivery. They bought from silver dealers and requested physical bars. They paid for vault storage, insurance, and transportation. They wanted metal, not paper. This strategy had multiple advantages. First, by taking physical delivery, they removed silver from the available market supply. Every bar sitting in a Hunt family vault was unavailable to industrial users or other traders. Second, physical possession eliminated counterparty risk. No one could default on a promise to deliver silver if you already owned the silver. Third, and most importantly, physical silver couldn't be inflated away by futures market manipulation. You see, futures markets operate on leverage. A trader can control large positions with relatively small margin deposits. This leverage allows for price discovery but also enables manipulation. If someone controls enough futures contracts, they can influence prices by rolling positions, creating artificial demand, or forcing short squeezes. But physical silver is different. Physical silver is finite. If the Hunt brothers owned 100 million ounces of physical silver, that was 100 million ounces that absolutely could not be delivered to anyone else. The metal existed, it was accounted for, and it was locked away. Bunker Hunt started small. In 1973, he began accumulating silver futures through various brokers. He used family trusts, personal accounts, and shell companies to disguise the size of his position. By late 1973, the Hunt brothers collectively owned approximately 35 million ounces, about 10% of annual global production. Silver prices barely moved. The market didn't notice. And that's when Bunker realized something important. The silver market was small enough that one determined buyer could corner it. Think about it. The entire global silver market, all the investment silver, all the tradable inventory, was maybe 300-400 million ounces at most. If someone could control 100-150 million ounces, they'd own a third of the available supply. At 1973 prices of 203 per ounce, that meant an investment of 300-450 million. A lot of money, but not impossible for billionaires with massive oil revenues. Herbert Hunt initially resisted the scale of Bunker's ambition. Buying 35 million ounces was aggressive but manageable. Buying 100 million ounces would require borrowing significant capital, tying up cash flow, and taking on risk that could threaten the family's core oil businesses. But Bunker was persuasive. He framed the silver investment as insurance against monetary collapse. If the dollar remained strong and inflation subsided, they'd lose some storage costs, but could sell at modest profits. If Bunker's inflation predictions came true, silver would skyrocket, and they'd make billions while protecting their wealth from currency debasement. What's interesting is that Bunker Hunt wasn't entirely wrong about macroeconomic trends. The 1970s were defined by stagflation, simultaneous high inflation and economic stagnation. The US abandoned the gold standard in 1971, removing the last anchor on currency creation. Oil prices quadrupled after the 1973 Arab oil embargo. By mid-decade, inflation was running 10% annually. Against this backdrop, hard assets did surge. Gold rose from $35 per ounce in 1970 to $200 by 1975. Real estate prices jumped. Commodity prices across the board increased. Investors were desperately seeking inflation hedges. Silver started rising too. By 1974, silver had reached $6 per ounce, triple its 1973 price. The Hunt brothers' early positions were already profitable. More importantly, Bunker's thesis seemed validated. Silver was responding to monetary instability exactly as he'd predicted. But here's where Bunker made a critical decision that would shape everything that followed. He decided to recruit allies. Operating alone, the Hunt brothers could control a significant silver position, but they faced limitations. Their borrowing capacity had limits. Their ability to disguise large positions had limits. And if they acted alone, they'd be vulnerable to regulatory pressure focused on a single family. Bunker needed partners who shared his monetary philosophy, had access to enormous capital, and operated outside direct US regulatory jurisdiction. He found them in the Middle East. The Arab oil embargo of 1973 had created a massive wealth transfer to oil-producing. Chapter 3. The Scheme. Cornering a commodity market isn't illegal, it's just very, very difficult. The classic commodity corner works like this. Accumulate a large physical position in a commodity, control a significant portion of the available supply, then squeeze short sellers and force them to pay premium prices to deliver on their obligations. If executed perfectly, the corner generates enormous profits as prices spike and desperate traders pay any price to cover their positions. But modern commodity markets have regulations specifically designed to prevent corners. Position limits restrict how much any single trader can control. Margin requirements force traders to deposit cash as collateral. Exchanges can change rules mid-game to prevent manipulation, and regulators like the Commodity Futures Trading Commission, CFTC, have authority to investigate and punish market manipulation. The Hunt brothers knew these barriers existed. Their solution was elegant. Don't break the rules. Exploit the loopholes. Here's the thing. Position limits in the 1970s applied to futures contracts, not physical silver. If you bought physical silver and took delivery, you were simply a commodity owner, no different from a jewelry manufacturer stockpiling inventory. Position limits didn't apply. This created an arbitrage opportunity. The Hunt brothers could buy futures contracts up to position limits, demand physical delivery before expiration, then store that silver in private vaults. Once the silver was delivered, it no longer counted toward their futures position limits. They could then buy more futures contracts, take delivery again, and repeat the cycle. Over several years, this strategy allowed them to accumulate far more silver than position limits would normally allow. And because the silver was stored in separate vaults under different corporate entities and family trusts, the concentration wasn't immediately obvious to regulators. Bunker Hunt refined this approach with additional sophisticated tactics. First, he exploited the delivery mechanism itself. Most futures traders never intend to take delivery. They trade contracts for price exposure, not physical commodities. Exchanges are designed around this assumption. Delivery is possible but rare, so exchanges maintain relatively small inventories of deliverable commodity in approved warehouses. When the Hunt brothers consistently demanded delivery, they strained the system. Refiners had to produce more physical bars, vaults had to expand storage capacity, transportation companies had to move thousands of bars to Hunt-controlled warehouses. This disruption created friction in the market and signaled to other traders that someone was accumulating aggressively. Second, Bunker used multiple brokers and accounts to disguise the scale of his operations. Each family member, Bunker, Herbert, and their sister Caroline, had separate brokerage accounts. The Hunt family trusts had accounts. Offshore corporations controlled by the Hunts had accounts. Each account stayed within position limits, but collectively they represented an enormous concentrated position. The regulatory system wasn't designed to catch this. Exchanges tracked individual accounts, but they didn't automatically aggregate positions across related parties unless those parties formally declared their coordination. The Hunt brothers never made such declarations. Third, and most importantly, the Hunt brothers created genuine strategic partnerships with Middle Eastern investors who had independent reasons to buy silver. These weren't straw men or shell companies. These were wealthy individuals and royal family members with their own capital making their own investment decisions. The key entity was International Metals Investment Company, IMIC, a Bermuda-based corporation funded primarily by Saudi and Kuwaiti money. IMIC bought enormous quantities of silver, eventually over 40 million ounces. Technically, IMIC was independent of the Hunt brothers. Bunker Hunt served as an advisor but didn't have formal control. But here's what made regulators suspicious. IMIC's silver purchases were remarkably well coordinated with Hunt family purchases. When the Hunts bought aggressively, IMIC bought aggressively. When the Hunts rolled futures positions, IMIC rolled similarly. The trading patterns were too correlated to be coincidental. You see, the Hunt brothers had created plausible deniability. They could claim they were independent investors who happened to share similar views about silver. They could point to IMIC's Middle Eastern ownership and argue they didn't control those positions. But functionally, the Hunt-IMIC alliance operated as a single coordinated strategy. This structure protected them from immediate regulatory action. The CFTC could see that silver positions were concentrating, but proving actual coordination between legally separate entities required evidence of conspiracy. Emails, meeting notes, explicit agreements. The Hunt brothers were careful to avoid creating that paper trail. Look, Bunker Hunt was methodical. He consulted with lawyers about position limits. He structured his operations to stay technically within regulations. He understood that commodity exchanges could change rules, so he focused on physical silver that couldn't be regulated away. But the most important element of the scheme was the fundamental imbalance it created in the silver market. Under normal conditions, the silver futures market operates in equilibrium. Producers sell futures to lock in prices. Industrial users buy futures to secure supply. Speculators trade both sides based on price expectations. The system works because supply roughly equals demand. The Hunt brothers broke this equilibrium by persistently taking delivery. They removed silver from the system faster than mines could produce it. By 1979, COMEX warehouse inventories, the physical silver available for delivery against futures contracts, had fallen from 160 million ounces in 1977 to less than 120 million ounces. This inventory decline created fear among short sellers. If you sold a silver futures contract, betting prices would fall. You were obligated to deliver physical silver at expiration. But if the Hunt brothers owned most of the available silver, where would you get the metal to deliver? This fear created a short squeeze, the exact scenario the Hunt brothers wanted. Short sellers became desperate to close their positions before delivery dates. They bid up futures prices to avoid the risk of failing to deliver. This buying pushed prices higher, which attracted more short sellers betting on a correction, which created more squeeze potential. A feedback loop was forming. By early 1979, silver had climbed to $6 per ounce, triple its price from earlier in the decade. The Hunt brothers' physical position was worth approximately $600 million. Their paper profits were substantial, but Bunker wasn't thinking about selling. He was thinking about the end game. Here's the genius of the scheme. If the Hunt brothers could push silver high enough, they'd force industrial users to buy from them at premium prices. Jewelry manufacturers, photography companies, electronics producers, they all needed silver. If the Hunt brothers controlled the available supply, they could dictate terms. But there was a catch. The higher prices rose, the more attention the Hunt brothers attracted. Media outlets started reporting on silver's unusual price movements. Regulators started asking questions. Other traders started investigating who was behind the buying. The Hunt brothers needed to accelerate. They needed to push the corner to completion before regulators could intervene. In mid-1979, Bunker Hunt made a critical decision: go all in. He increased borrowing to buy even more silver. He convinced his Middle Eastern partners to expand their positions. He used his existing silver holdings as collateral to borrow money to buy more silver, a leveraged bet that multiplied both potential profits and risks. Herbert Hunt grew concerned about the leverage. They were borrowing hundreds of millions of dollars secured by silver that was rising in price based partly on their own buying. If prices fell, they'd face margin calls and potential forced liquidation. But Bunker was convinced they were close to total victory. What's interesting is that external events seem to validate Bunker's timing. In 1979, geopolitical chaos accelerated. The Iranian Revolution toppled the Shah, creating oil supply disruptions. The Soviet Union invaded Afghanistan, raising Cold War tensions. The Federal Reserve, under new chairman Paul Volcker, began raising interest rates aggressively to fight inflation. But in the short term, this created economic anxiety. Gold prices exploded from $200 to $500, then toward $800. Silver, moving in sympathy with gold, surged from $6 to $10, then toward $20 by the end of 1979. The Hunt brothers' positions were suddenly worth billions. Bunker Hunt was vindicated. His prediction of monetary chaos and soaring precious metal prices was playing out exactly as forecast. The silver corner was working, but behind the scenes, alarms were ringing throughout the financial system. COMEX officials watched warehouse inventories plummet. The Chicago Board of Trade tracked the concentration of positions. The CFTC opened preliminary investigations. Jewelry manufacturers like Tiffany Co started screaming about unsustainable silver prices, destroying their businesses. The Hunt brothers had won the corner. What they didn't realize was that winning would trigger forces powerful enough to destroy them. Chapter 4. Market Control. By September 1979, the Hunt brothers and their allies controlled approximately 130 million ounces of physical silver, plus millions more ounces through futures contracts. At prevailing prices around $10 per ounce, their position was worth $1.3 billion. But the real number was larger, much larger. When you factor in leverage, the futures contracts controlled with margin deposits, the Hunt-IMIC alliance had exposure to nearly 280 million ounces of silver. This represented roughly half of annual global production and more than a third of all investment-grade silver in existence. No private individual or group had controlled such a large percentage of a global commodity market since the Gilded Age corners of the late 1800s. The scale of control was staggering. COMEX warehouse inventories had fallen below 100 million ounces. The London Metal Exchange reported similar inventory declines. Silver available for immediate delivery, the critical metric for industrial users and short sellers, was increasingly concentrated in Hunt-controlled vaults. This concentration gave the Hunt brothers unprecedented power. They could influence prices simply by announcing their intentions. When Bunker Hunt gave interviews suggesting silver would reach $100 per ounce, prices jumped on his words alone. When IMIC took delivery of massive silver shipments in Europe, traders scrambled to understand the implications. Industrial users faced a crisis. Kodak's silver costs were skyrocketing, threatening profit margins on film sales. Electronics manufacturers in Japan and Germany worried about supply disruptions. Jewelry retailers watched customers balk at high prices, destroying wedding and Christmas sales. The situation was exactly what Bunker Hunt had predicted. He controlled a critical commodity. Industrial users needed it, and they'd have to negotiate with him to get it. But here's what Bunker didn't fully appreciate. His corner was creating systemic risks that would force government intervention. Let me explain how leverage was multiplying the danger. The Hunt brothers had borrowed aggressively to maximize their silver positions. They used their oil company revenues as cash flow to support margin requirements. They borrowed against their physical silver holdings to buy more silver. They leveraged their real estate and other assets to expand their futures positions. This worked beautifully in a rising market. As silver prices climbed, the value of their collateral increased, allowing them to borrow even more. Their brokers, firms like Bash & Co., Merrill Lynch and ACLI, were happy to extend credit because the Hunt family was wealthy. The collateral seemed solid and the commissions were enormous. But this leverage created a hidden vulnerability. If silver prices fell sharply, the Hunt brothers would face massive margin calls, demands to deposit additional cash to maintain their positions. And if they couldn't meet those margin calls, their brokers would be forced to liquidate their positions, selling silver into a falling market and creating a death spiral. The brokerage firms themselves were at risk. Bash & Co. alone had extended over $400 million in credit to the Hunt brothers. If the Hunts defaulted, Bash faced potential bankruptcy, and if Bash failed, it could trigger a cascade of failures across Wall Street. Think about it. The Hunt brothers had created a systemic risk to the American financial system by cornering a commodity market. This was exactly the scenario regulators were supposed to prevent. The Commodity Futures Trading Commission began investigating in earnest. The CFTC had been created in 1974 specifically to regulate futures markets after commodity price volatility during the early 1970s. But the agency was young, understaffed, and had never faced a market manipulation of this scale. CFTC investigators requested trading records from exchanges and brokerage firms. They interviewed traders and market participants. They tried to map the connections between Hunt family accounts, IMIC positions, and Middle Eastern investors. What they discovered was deeply troubling. The Hunt brothers and their allies held positions far exceeding the original spirit of position limits, even if they technically complied with the letter of the rules. The coordinated buying pattern suggested an organized effort to corner the market, and the leverage involved created risks that extended far beyond the silver market itself. But proving illegal market manipulation was difficult. The Hunt brothers had lawyers who argued they were simply long-term investors with strong convictions about silver's value. They pointed out that they'd held positions for years, not days. This wasn't speculative trading, but rather strategic accumulation. They noted that inflation and geopolitical instability justified silver's rising prices. COMEX, the primary exchange where silver traded, faced an impossible dilemma. Exchange rules required them to maintain orderly markets and prevent manipulation, but the Hunt brothers were operating within the technical boundaries of existing regulations. If COMEX changed rules to specifically target the Hunts, they'd face lawsuits claiming discriminatory treatment. You see, commodity exchanges are membership organizations run by traders. The exchange officials knew the silver market was dangerously distorted, but they needed political cover to act. They needed regulators to give them authority to impose new restrictions, and they needed to move carefully to avoid legal challenges that could drag on for years. Meanwhile, silver prices kept climbing. By December 1979, silver hit $20 per ounce. By early January 1980, it reached $30. The Hunt brothers' position was now worth over $4 billion. Bunker Hunt was reportedly the richest man in America, wealthier than his father had ever been. But the higher prices rose, the more desperate the opposition became. Jewelers organized to demand regulatory action. Tiffany Co took out full-page ads in the New York Times, blaming the Hunt brothers for destroying the silver jewelry market. The ad read, "We think it is unconscionable for anyone to hoard several billion, yes $1 billion worth of silver, and thus drive the price up so high." Industrial users lobbied Congress. Photography companies explained that silver shortages threatened their businesses. Electronics manufacturers warned about supply chain disruptions. The political pressure was building. What's interesting is that the Hunt brothers genuinely believed they were being persecuted for succeeding. Bunker gave interviews defending his strategy. He argued that silver was fairly valued at $30 or even higher. He claimed that inflation was the real problem, and that his silver holdings were simply protecting his wealth from government monetary mismanagement. He wasn't entirely wrong. Inflation in late 1979 was running at 13.3% annually. Gold had hit $800 per ounce, 20 times its price from a decade earlier. In that context, silver at $30 didn't seem absurd. It seemed like a natural response to monetary instability. But markets aren't just about fundamentals. They're about supply, demand, and the balance between buyers and sellers. And the Hunt brothers had destroyed that balance by removing so much physical silver from circulation. Short sellers were being annihilated. Traders who had bet against silver prices faced catastrophic losses. Some had sold silver at $6, expecting it to fall to $4. Instead, it rose to $30. They were underwater by a factor of 5. To close their positions, they had to buy silver at any price, which pushed prices even higher. This short squeeze created a feedback loop. Rising prices forced short covering. Short covering pushed prices higher. Higher prices attracted media attention and speculative buying from small investors. More buying created more upward pressure. By mid-January 1980, silver was approaching $50 per ounce. The Hunt brothers' position was worth approximately $5 billion, equivalent to $17 billion today. They had pulled off one of the most successful commodity corners in history. But the establishment was about to fight back with every tool available. On January 7, 1980, COMEX announced a rule change. New position limits would restrict any single trader or group of related traders to 600 contracts in the spot month, equivalent to 3 million ounces. Existing positions above that limit would have to be reduced or moved to later delivery months. The rule specifically targeted the Hunt brothers. It was designed to force them to either liquidate or roll their positions forward, relieving pressure on near-term supply. The Hunt brothers challenged the rule in court, arguing it was discriminatory and violated their property rights. But they knew the writing was on the wall. Regulators were moving against them. Then on January 21, 1980, COMEX went further. The exchange implemented Silver Rule 7, a regulation that essentially prohibited new purchases of silver futures except for liquidation of existing positions. You could sell silver futures, you couldn't buy them. This was unprecedented. The exchange had changed the rules mid-game to stop a market corner. The Hunt brothers understood immediately what this meant. Without the ability to buy futures, they couldn't roll positions forward. When their existing contracts expired, they'd be forced either to take delivery of massive additional physical silver, which would require enormous storage capacity and cash, or to sell into a falling market. The corner was being broken by regulatory fiat. Silver prices peaked at $49.45 per ounce on January 18, 1980. Then they started falling. At first, the decline was orderly, profit-taking from speculators who'd ridden the rally, natural selling pressure from industrial users who'd been hoarding inventory during the price spike. Silver fell to $40, then $35. But the Hunt brothers faced a terrible choice. They were massively leveraged. Falling prices meant margin calls. To meet those margin calls, they needed either to deposit more cash or to sell silver. But selling silver would push prices lower, creating more margin calls in a vicious cycle. Herbert Hunt, who'd always been more cautious than his brother, recognized the danger immediately. They were caught in exactly the leverage trap he'd feared. Bunker insisted they could ride it out. Silver was still fundamentally undervalued, he argued. The price decline was temporary manipulation by the establishment. If they held firm, prices would recover. But the market didn't care about Bunker's convictions. The market cared about supply and demand. And with the Hunt brothers unable to buy more futures, the buying pressure that had driven prices to $50 evaporated. By February, silver was trading around $35. By early March, it hit $25. The Hunt brothers' paper profits were vanishing by the hundreds of millions of dollars per week, and their brokers were getting very, very nervous. Chapter 5. Price Explosion. The period from September 1979 to January 1980 represented the peak of the Hunt brothers' power. During these 5 months, they achieved what many thought impossible. They cornered the global silver market. But understanding how the price explosion happened requires understanding the mechanics of futures markets and the psychology of market participants. Futures contracts are standardized agreements to buy or sell a commodity at a specified future date. A silver futures contract on COMEX represented 5,000 ounces of silver. Traders posted margin, typically 10 to 20% of the contract value, as a deposit to guarantee performance. This leverage amplified price movements dramatically. If silver rose $1 per ounce, a 5,000-ounce contract gained $5,000 in value, far more than the original margin deposit. This made futures markets volatile and attractive to speculators. In normal markets, leverage works both ways. Bulls and bears trade against each other. Prices fluctuate, but tend toward equilibrium based on supply and demand fundamentals. The Hunt brothers broke this equilibrium by being relentless, one-directional buyers. They didn't trade silver, they accumulated it. Month after month, year after year, they bought futures contracts, demanded delivery, and stored the physical metal. This persistence created something unusual, a market where bulls overwhelmed bears. Short sellers expected eventually the Hunt brothers would take profits and sell. That selling pressure would create opportunity to profit from a price decline, but the Hunts never sold. They only bought. This confounded traditional trading strategies. By late 1979, short sellers faced an impossible situation. They'd sold futures contracts at $10, $15, or $20 per ounce, expecting prices to fall. Instead, prices kept rising. Their losses mounted. And critically, they couldn't cover their positions because doing so required buying silver, which pushed prices even higher. This created the classic short squeeze. Imagine you sold a silver contract at $15, betting the price would fall to $10. You'd make $25,000 per contract if you were right, but instead, silver rises to $25. You're now losing $50,000 per contract. Your broker demands you deposit more margin to cover potential losses. You face a choice. Deposit more cash or buy silver to close the position and lock in your loss. But if you buy to cover, you're pushing the price higher, creating losses for other short sellers who are forced to cover, which pushes prices higher still. It's a cascade. This is exactly what happened in late 1979. As silver climbed from $10 to $20, short sellers started covering. Their buying accelerated the rally to $30. More short sellers panicked and covered. Prices exploded to $40, then toward $50. The Hunt brothers had engineered a perfect squeeze. But here's what made the situation extraordinary. The squeeze wasn't just financial, it was physical. You see, many industrial users of silver had sold futures contracts to hedge their future silver needs. A photography company might sell silver futures today to lock in prices for next year's production. This is normal hedging, not speculation. But if silver prices exploded and those companies needed to deliver physical silver against their futures contracts, they faced a problem. Where would they get the metal? The Hunt brothers owned it. Warehouse inventories were depleted. New mine production was already committed. This physical shortage amplified the financial squeeze. It wasn't just about price movements on paper, it was about actual silver availability. COMEX warehouse inventories told the story. In 1977, eligible silver stocks, metal available for delivery, totaled about 160 million ounces. By December 1979, inventories had fallen below 80 million ounces. By January 1980, they were approaching 60 million ounces. The Hunt brothers and IMIC had drained the system. Meanwhile, new investors piled into silver, attracted by the spectacular price gains. Small speculators bought silver coins from dealers. Investors purchased silver mining stocks. Hedge funds established silver positions. The rally fed on itself. Media coverage intensified the frenzy. Headlines screamed about silver's incredible rise. Financial commentators debated whether silver could reach $100 per ounce. Bunker Hunt gave interviews predicting even higher prices. The psychological dynamics were powerful. If you were an investor watching silver rise from $10 to $40 in 6 months, you faced FOMO, fear of missing out. Even skeptical traders considered whether the Hunt brothers might be right about monetary collapse. What if silver really did reach $100? This speculative buying added fuel to the rally, but it also created danger. The speculative buyers weren't long-term holders like the Hunt brothers. They were momentum traders who'd sell at the first sign of weakness. Their buying pushed prices higher, but their potential selling created future instability. Gold's parallel rally reinforced silver's rise. When gold hit $800 per ounce in January 1980, silver's rise to $50 seemed proportional. The gold-to-silver ratio fell to 16:1, close to its historical average. This suggested silver might even have room to rise further if gold continued climbing. But there was a critical difference between gold and silver that the Hunt brothers underestimated. Gold is primarily a monetary metal. Central banks hold it, investors hoard it. Industrial uses are limited. Gold markets can sustain high prices because supply is relatively inelastic. Mines can't suddenly flood the market with new gold. Silver is different. Silver has massive industrial demand. If prices rise too high, industrial users substitute other materials. Manufacturers redesign products to use less silver. Recyclers work overtime to recover silver from scrap. These forces create price resistance. At $50 per ounce, silver was economically problematic. Jewelry manufacturers stopped production. Some photography companies explored alternative processes. Electronics manufacturers investigated substitute conductors. The high prices were destroying the demand that supposedly justified those high prices. Look, Bunker Hunt believed silver's monetary properties would sustain high prices regardless of industrial demand. He thought silver would become a currency again, but he was wrong. The world had moved beyond silver currency. Industrial users simply adapted to high prices by using less silver. This demand destruction would eventually matter, but not immediately. In January 1980, the momentum was still upward. The short squeeze was still functioning, and the Hunt brothers were still refusing to sell. But behind the scenes, the forces that would destroy them were organizing. Jewelers lobbied Congress with increasing urgency. They brought evidence of economic harm, stores closing, craftsmen unemployed, an entire industry threatened by manipulated prices. Congressional committees demanded regulatory agencies take action. The Federal Reserve watched nervously. If the Hunt brothers' corner triggered a broader financial crisis, if major brokerage firms failed because of Hunt-related losses, the Fed might need to intervene to prevent systemic collapse. Fed officials began quiet discussions about emergency lending facilities. The White House received briefings about the silver market. President Carter's economic advisors warned that commodity market manipulation was creating political problems. Inflation was already a massive political liability heading into the 1980 election. A silver crisis would make it worse. Treasury officials worried about international implications. Foreign central banks held dollar reserves. If the dollar's collapse accelerated, as the Hunt brothers predicted, it would destabilize international finance. The Treasury wanted the silver corner broken. All these forces converged in January 1980. The establishment, regulators, exchanges, political leaders, decided the Hunt brothers had to be stopped. COMEX's rule changes were the opening salvo. Position limits, restrictions on new buying, forced liquidation requirements. These regulations were specifically designed to break the corner. But the exchanges went further. They raised margin requirements dramatically. Where silver futures had required 10% margin, exchanges suddenly demanded 25%, then 50%, then even higher. This forced all leveraged traders to deposit massive additional cash or liquidate positions. The higher margin requirements affected everyone in the silver market, but they specifically targeted the Hunt brothers. With their enormous leveraged positions, they faced margin calls in the hundreds of millions of dollars. Bunker Hunt protested that the rule changes were discriminatory, that they violated free market principles, that regulators were protecting short sellers who'd made bad bets. He wasn't entirely wrong. The rule changes did protect short sellers at the expense of the longs, but regulators had decided that protecting the integrity of the financial system was more important than protecting any single trader's profits. When COMEX implemented Silver Rule 7 on January 21st, prohibiting new purchases except to liquidate existing positions, the market understood immediately what was happening. The squeeze was being broken by force. Prices peaked at $49.45 on January 18, 1980. By January 22nd, silver had fallen to $42. By the end of January, it was $37. The decline was orderly at first, profit-taking and position reduction by speculators who'd ridden the rally. But the Hunt brothers faced a terrible dilemma. Their entire strategy depended on continuous buying to maintain upward price pressure. Without the ability to buy, they couldn't support prices. And falling prices meant margin calls. They started receiving calls from their brokers. Batch demanded $100 million in additional margin. Merrill Lynch wanted $50 million. ACLI needed $75 million. The numbers kept coming. Herbert Hunt liquidated other assets to raise cash. They sold oil properties. They borrowed against their real estate. They used every financial resource available to meet margin calls, but it wasn't enough. By early February, silver was trading at $34. The Hunt brothers' paper profits had evaporated by over $1 billion. They were still massively long silver, but now the position was losing money daily. And the brokers were starting to panic. If the Hunt brothers couldn't meet margin calls, the brokers would be forced to liquidate Hunt positions in a falling market, potentially creating losses the brokers themselves would have to absorb. The stage was set for catastrophe. The Hunt brothers were massively leveraged, unable to buy more to support prices, and facing accelerating margin calls. Their brokers were exposed to enormous credit risk, and silver prices were in free fall. What nobody knew was how close the entire system was to complete collapse. Chapter 6. Silver Thursday, March 27, 1980. The day Wall Street calls Silver Thursday. Silver opened trading at $15.80 per ounce, down from $50 just 9 weeks earlier. The Hunt brothers' positions had lost billions. Their brokers faced potential insolvency, and the American financial system teetered on the edge of a systemic crisis. This is how empires collapse. The morning started with panic. Overnight, silver had fallen another $5 per ounce in overseas markets. Asian and European traders were liquidating positions, fearing further declines. When New York markets opened, the selling accelerated. The Hunt brothers faced catastrophic margin calls. Batch & Co. alone was owed over $400 million. Merrill Lynch wanted $150 million. ACLI demanded $90 million. Across multiple brokers, the total exceeded $1 billion in immediate margin demands. Bunker and Herbert Hunt didn't have $1 billion in liquid cash. They had oil wells, real estate, cattle ranches, and art collections. They had enormous wealth, but it was tied up in illiquid assets that couldn't be sold immediately. They tried desperately to raise cash. They approached banks for emergency loans. They offered their silver holdings as collateral. They called business associates begging for bridge financing. Nothing worked fast enough. By mid-morning, the brokers made their decisions. If the Hunt brothers couldn't meet margin calls, the brokers had to liquidate Hunt positions to protect themselves. But here's the nightmare scenario. The Hunt brothers' silver position was so large that forced liquidation would crater prices, and falling prices would trigger more margin calls on the remaining positions, forcing more liquidation in a death spiral. Bash and Herbert started selling Hunt Silver holdings. Thousands of contracts dumped on the market. Prices plunged. Silver fell from $15 to $13 to $11. Trading volume was chaotic. The market was breaking. Other traders smelled blood. They sold silver short, betting the Hunt collapse would push prices even lower. Hedge funds piled on. Speculators who'd bought at $40 were desperately selling at any price to salvage something. You see, this wasn't just about the Hunt brothers anymore. This was a market panic. When prices move fast enough, traders stop analyzing fundamentals. They just react. Sell now, ask questions later, and in a panic, prices can detach completely from rational valuation. By noon, silver was trading at $10.80. The COMEX floor was chaos. Traders were screaming orders. Exchange officials huddled to discuss emergency measures. Rumors were flying. The Hunt brothers were bankrupt. Bash was insolvent. The exchange would close trading. What most people didn't know was how close the entire financial system was to collapse. Bash & Co. had extended over $400 million in credit to the Hunt brothers. If the Hunts defaulted, and it looked like they would, Bash would suffer massive losses that could wipe out its capital. Bash was a major brokerage firm with thousands of customers and billions in client assets. If Bash failed, it would trigger a crisis of confidence across Wall Street. But it was worse than that. Bash had borrowed money from major banks to finance its lending to the Hunt brothers. If Bash failed, those banks would suffer losses. If banks started failing, the entire banking system would be at risk. The Federal Reserve was watching in real time. Fed officials understood that a Hunt bankruptcy could cascade through the financial system. They began preparing emergency measures. Meanwhile, the Hunt brothers were negotiating desperately. They needed time to liquidate other assets to raise cash. They called the heads of their brokers directly, pleading for patience. They offered additional collateral. They proposed debt restructuring plans. Herbert Hunt was near collapse from stress. They'd built this empire over decades. The Libyan oil fields, the domestic oil properties, the diversified business holdings, all of it was now at risk because of a leveraged bet on silver that had gone catastrophically wrong. Bunker Hunt remained defiant. He insisted silver was fundamentally undervalued and that forced selling was creating a temporary artificial price. He argued they should hold firm and ride out the crisis. But Herbert understood they didn't have that option. The margin calls were immediate. The liquidation was happening whether they wanted it or not. By early afternoon, several things happened nearly simultaneously. First, a consortium of banks led by First National Bank of Chicago agreed to provide an emergency loan to the Hunt brothers. The loan was $1.1 billion, secured by virtually everything the Hunt family owned. Their oil properties, real estate, art collections, livestock operations, all pledged as collateral. The loan was enough to meet the most urgent margin calls and stop the forced liquidation. But the terms were brutal. The banks charged premium interest rates. They demanded first priority on all Hunt assets. They required the Hunt brothers to develop an orderly liquidation plan for their silver holdings to repay the loan. Second, the Federal Reserve issued a statement that it stood ready to provide liquidity to the financial system to ensure stability. This was carefully worded to avoid creating panic, while signaling that the Fed would prevent broker failures if necessary. Third, COMEX announced it would maintain orderly markets and had adequate resources to handle the current situation. This was partly bluff. The exchange was barely holding together, but the announcement helped calm traders. By market close, silver had stabilized at $10.40 per ounce. Trading volume was massive. Volatility was extreme, but the market hadn't collapsed completely. The Hunt brothers had survived, barely. They'd avoided immediate bankruptcy, but their silver corner was finished. They'd gone from paper profits of $5 billion to losses of billions. Their entire strategy lay in ruins. Wall Street breathed a collective sigh of relief. The systemic crisis had been averted. Major brokerage firms survived. Banks didn't fail. The disaster scenario, financial contagion spreading through the system, didn't materialize, but the cost was enormous. The Hunt brothers would spend years liquidating assets to repay their debts. Bash & Co. survived, but suffered massive losses and was eventually acquired by Prudential Securities. Several smaller brokers involved in silver trading failed or were absorbed by larger firms. What's interesting is that the Hunt brothers genuinely believed they were victims of a conspiracy. Bunker Hunt gave interviews claiming the establishment had changed rules mid-game to protect short sellers and punish successful investors. He argued that if the exchanges hadn't imposed position limits and buying restrictions, silver prices would have continued rising, and their strategy would have succeeded. He wasn't entirely wrong. The rule changes did target the Hunt brothers specifically. The exchanges and regulators did coordinate to break the corner. In a pure free market without intervention, the outcome might have been different. But the counter-argument was simple. Commodity markets can't function if individual traders are allowed to corner supply. The exchanges have a responsibility to maintain orderly markets, and when one family's speculation threatens systemic financial stability, intervention is justified. The truth probably lies somewhere between these extremes. The Hunt brothers were aggressive investors who exploited regulatory loopholes. The exchanges were membership organizations that changed rules to protect their members from a predatory corner. The regulators were government agencies trying to prevent a financial crisis. Nobody was purely right or purely wrong, but the outcome was clear. The Hunt brothers lost, and they lost catastrophically. Silver Thursday marked the end of the corner, but the legal and financial consequences would haunt the Hunt family for years. Chapter 7: The Collapse. The months following Silver Thursday were brutal for the Hunt brothers. The $1.1 billion bank loan had saved them from immediate bankruptcy, but it came with devastating conditions. They were required to liquidate their silver holdings in an orderly manner to repay the debt. They couldn't simply hold and wait for prices to recover. They had to sell, and selling into a depressed market meant locking in massive losses. The Hunt brothers began selling their physical silver holdings. The process took months. They sold through dealers, through private negotiations, and eventually through public auctions. Each sale further depressed silver prices, which created more losses on their remaining positions. Silver stabilized around 10 to 12 per ounce through 1980, but it never recovered to the highs of January. The market had been traumatized. Investors who'd been burned by the volatility avoided silver. Industrial users found substitute materials. The fundamental supply-demand dynamics had shifted permanently. By late 1980, the Hunt brothers had liquidated most of their futures positions, but they still held enormous quantities of physical silver in storage. This metal represented their remaining wealth, but it was worth a fraction of what they'd paid for it. The real estate and other assets pledged as collateral started being sold off. The banks demanded payment, and the Hunt brothers had no choice but to liquidate. Oil properties sold at fire sale prices. Ranch land went to buyers who knew the Hunts were desperate. Art collections were auctioned. Herbert Hunt, always the more conservative brother, was devastated. He'd built careful business relationships over decades. Now creditors were circling, demanding payment. Business partners were distancing themselves. The Hunt family name, once synonymous with Texas wealth and success, had become associated with spectacular failure. Bunker Hunt remained bitter. He gave interviews blaming regulatory intervention for destroying his silver investment. He argued that commodity markets were rigged against large investors. He portrayed himself as a victim of government overreach rather than a market manipulator who'd gotten caught. But the legal problems were just beginning. In 1982, the Commodity Futures Trading Commission filed charges against the Hunt brothers, alleging market manipulation. The CFTC complaint detailed how the Hunt-IMIC alliance had coordinated buying to corner the silver market, how they'd violated the spirit, if not the letter, of position limits, and how their actions had destabilized commodity markets. The case dragged through courts for years. The Hunt brothers hired expensive lawyers and fought every allegation. They argued their silver buying was legitimate investment, not manipulation. They claimed the government was prosecuting them for being successful long-term investors. The legal expenses were crushing. Lawyers' fees alone consumed millions of dollars. The distraction of litigation prevented the Hunt brothers from focusing on their remaining businesses. And the public relations damage was severe. They were portrayed in media as greedy manipulators who'd nearly crashed the financial system. In 1988, 8 years after Silver Thursday, the legal battle finally concluded. The Hunt brothers were found guilty of conspiring to manipulate the silver market. They were banned from trading commodities and fined millions of dollars. But the financial penalties weren't the worst consequence. The Hunt family's business empire was destroyed. Hunt Oil Company, the family's core business, survived, but it was much smaller than before. The Libyan properties were long gone. The domestic oil fields had been sold to pay debts. The diversified holdings were liquidated. What remained was a fraction of the empire H.L. Hunt had built. Herbert Hunt filed for personal bankruptcy in 1988. His assets were insufficient to cover his debts. The man who'd once been worth billions was bankrupt. He spent his remaining years managing what little remained of the family's Texas properties. Bunker Hunt fought bankruptcy longer, but eventually he too filed in 1988. His debts exceeded $2.5 billion. His remaining assets, oil wells, real estate, silver still in storage, were valued at approximately $1 billion. The man who'd briefly been the richest person in America was bankrupt. The bankruptcy proceedings were humiliating. The Hunt brothers' personal possessions were inventoried and auctioned. Bunker's legendary thoroughbred horses were sold. Herbert's art collection was dispersed. Creditors picked over the remaining Hunt assets like vultures. What's particularly tragic is that if the Hunt brothers had simply held their silver without leverage, they would have been fine. The physical silver they owned eventually sold for enough to have preserved significant wealth. But the leverage, the borrowed money used to maximize their position, had destroyed them. Think about it. They'd used debt to amplify their silver position. When prices rose, leverage multiplied their gains. But when prices fell, leverage multiplied their losses and triggered margin calls that forced catastrophic liquidation at the worst possible moment. This is the timeless lesson of leverage. It works wonderfully until it doesn't, and when it fails, it destroys even the wealthiest investors. The collapse of the Hunt brothers sent shockwaves through commodity markets. Regulations were tightened. Position limits were strengthened. Exchanges gained more authority to intervene in potential corners. The CFTC's budget and enforcement capabilities were expanded. The goal was to prevent anyone from ever again accumulating the kind of concentrated position the Hunt brothers had built. The silver corner became the textbook case for why commodity market regulation was necessary. But here's what's interesting: the fundamental concerns that drove the Hunt brothers' silver obsession weren't entirely wrong. Inflation in the late 1970s was real. Government monetary policy was destructive. Hard assets did outperform paper assets for a period. The Hunt brothers' mistake wasn't their analysis, it was their execution. They tried to corner a market rather than simply investing in it. They used leverage rather than buying within their means. They became ideologues rather than remaining pragmatic investors. If Bunker Hunt had bought $200 million worth of silver in 1973 and simply held it without leverage, he would have made a fortune. Silver rose from $2 to $50, a 25x return. Even after the crash to $10, he would have quintupled his money. Without leverage, without attempting a corner, he would have succeeded. Instead, he became obsessed with controlling the market. He recruited allies. He used debt. He fought regulators, and he lost everything. The Hunt brothers' legacy became a cautionary tale in every business school in America. MBA students study Silver Thursday as an example of how leverage, market manipulation, and regulatory risk can destroy even the wealthiest investors. But there's a deeper lesson too. Markets are bigger than any individual. No matter how wealthy, no matter how confident, no matter how convinced of your analysis, the market will eventually defeat attempts at manipulation. The Hunt brothers learned this lesson the hardest way possible. The weeks following Silver Thursday revealed something beyond financial collapse. They revealed the human cost of spectacular failure. Herbert Hunt, always the more emotionally vulnerable of the two brothers, suffered what family members later described as a nervous breakdown. He'd spent sleepless nights during March 1980, fielding phone calls from panicked brokers, angry creditors, and concerned family members. The stress manifested physically. He lost weight, developed stress-related health issues, and reportedly required medical attention. For Herbert, the collapse represented more than lost money. It represented the destruction of his life's work. He'd spent decades building business relationships, earning respect in Dallas society, and managing the family's diversified holdings. In a matter of weeks, those relationships soured, that respect evaporated, and those holdings were being liquidated at fire sale prices. Bunker Hunt's response was different, but equally telling. He became increasingly paranoid, convinced that a conspiracy of regulators, exchanges, and short sellers had deliberately destroyed him. In private meetings with lawyers and advisors, he would rant about government persecution and market manipulation, apparently oblivious to the irony that he was accusing others of the very manipulation he'd attempted. This psychological response, deflecting blame, seeking external explanations for failure, refusing to acknowledge personal responsibility, is common among failed speculators. Admitting that his strategy was fundamentally flawed would have meant admitting that years of planning, billions in investment, and his father's monetary philosophy were all misguided. That admission was psychologically impossible for Bunker. The Hunt family's internal dynamics became strained to the breaking point during the collapse. Hunt brothers had numerous siblings from their father's three families. Many had received inheritances from H.L. Hunt, but hadn't participated in the silver speculation. Now they watched as Bunker and Herbert's catastrophic failure tarnished the entire Hunt family name. Lamar Hunt, Bunker, and Herbert's younger half-brother who'd built his own fortune in sports franchises. He founded the American Football League and owned the Kansas City Chiefs, maintained careful distance from the silver debacle. He'd always operated independently from his brothers, and the silver collapse vindicated his decision to stay out of their schemes. Caroline Hunt Schulkopf Bunker and Herbert's sister had participated in some of the early silver buying, but had exited her positions before the peak. She disagreed with the escalating leverage and had quietly sold most of her holdings in 1979. This decision saved her fortune and allowed her to continue building her hotel empire, the Rosewood Hotels chain. Family gatherings became awkward affairs where unspoken tensions about the silver disaster hung over every conversation. The younger generation of Hunts, Bunker and Herbert's children faced their own challenges. Growing up as heirs to one of America's great fortunes, they'd expected lives of wealth and privilege. Instead, they watched their fathers declare bankruptcy and saw the family name become synonymous with financial failure. Some changed their surnames or moved away from Texas to escape the He association. The liquidation of Hunt assets to repay debts created opportunities for vulture investors who understood the family's desperation. The Hunt brothers owned prize thoroughbred horses, including Dahlia, a champion mare that had won races across Europe and America. These horses were worth millions in normal market conditions, but when creditors demanded immediate payment, the Hunts were forced to sell at auction under pressure. Buyers knew the situation and bid accordingly. Horses that should have fetched $2 or $3 million sold for $500,000 or less. Real estate holdings faced similar treatment. The Hunt brothers owned office buildings in Dallas, ranch land across Texas, and residential properties in multiple states. In a normal market, they could have marketed these properties strategically to maximize value. Instead, they needed cash immediately. Real estate brokers negotiated, knowing the Hunts had no leverage. Properties sold for 40-60 cents on the dollar. Art collections Bunker had accumulated significant Western and Native American art were auctioned off. Cattle operations that had been family holdings for generations were sold to competitors. Oil and gas properties were acquired by other petroleum companies at distressed prices. Each sale represented not just financial loss, but also personal humiliation. These were assets the Hunt brothers had carefully accumulated over decades. They represented taste, heritage, and the family legacy built by H.L. Hunt. Watching them sold off piecemeal to pay debts incurred from a failed speculation was devastating. Behind the scenes, complex negotiations unfolded between the Hunt brothers and their various creditors. The banks that had provided the $1.1 billion emergency loan formed a creditor committee to maximize their recovery. They hired forensic accountants to inventory every Hunt asset. They brought in appraisers to value properties. They interviewed the brothers' business associates to discover any hidden assets or offshore holdings. The process was invasive and humiliating. Bank representatives visited the Hunt brothers' homes to inventory personal possessions. They examined jewelry, furniture, and artwork to determine what could be seized. They interviewed staff members about the family's lifestyle and spending habits. Some creditors were sympathetic, understanding that the Hunts were victims of their own hubris rather than malicious fraudsters. Others were vindictive, seeing an opportunity to extract maximum value from desperate borrowers. The negotiations could be brutal. Tiffany Co, which had extended the most credit to the Hunts, faced its own crisis. The firm's survival depended on recovering as much as possible from Hunt assets. Batch executives personally met with Bunker and Herbert, demanding access to every financial record, every bank account, every asset of any value. The Hunt brothers tried to negotiate terms, requesting time to sell assets at better prices, asking for partial debt forgiveness, proposing extended repayment schedules. But they had no leverage. The creditors controlled the process, and the Hunts had no choice but to comply. The broader commodity trading industry watched the Hunt brothers collapse with a mixture of schadenfreude and concern. Many commodity traders had been hurt by the Hunt brothers' corner. They'd lost money on short positions, suffered through unprecedented volatility, and seen their businesses disrupted by the silver manipulation. When the Hunts failed, there was satisfaction that the manipulators had gotten what they deserved, but there was also worry. The Hunt brothers had been extraordinarily wealthy, sophisticated investors with access to the best legal and financial advice. If they could lose everything through commodity speculation, who was safe? The collapse triggered a broader reassessment of risk in commodity markets. Trading firms implemented stricter internal position limits. Brokerage houses became more cautious about extending credit to clients, even wealthy ones. Commodity exchanges accelerated discussions about regulatory reforms that would eventually reshape the industry. Some traders saw opportunity in the chaos. They'd learned from the Hunt brothers' mistakes and believed they could execute commodity strategies more successfully with less leverage and better risk management. Others abandoned commodity speculation entirely, deciding the risks weren't worth the potential rewards. As the full scale of the Hunt brothers' losses became public, media coverage intensified. Financial journalists competed to uncover new details about the Silver Corner and its collapse. They interviewed former Hunt employees, obtained leaked financial documents, and pieced together the timeline of decisions that led to disaster. Each revelation generated new headlines and further damaged the Hunt family's reputation. Business magazines ran cover stories analyzing what went wrong. The Wall Street Journal published investigative pieces examining the regulatory failures that had allowed the corner to develop. Forbes profiled the Hunt brothers' rise and fall as a morality tale about hubris and leverage. Local Dallas media coverage was particularly intense. The Hunts had been Dallas royalty, major employers, prominent philanthropists, pillars of society. Therefore was the biggest local story in decades. Television news trucks parked outside Hunt properties. Reporters ambushed family members seeking comments. The coverage was relentless and often cruel. Bunker and Herbert largely retreated from public view during this period. They declined interview requests, avoided public events, and communicated primarily through lawyers. This silence created a vacuum that media filled with speculation, rumor, and increasingly harsh judgment. The public narrative solidified. The Hunt brothers were greedy manipulators who'd nearly crashed the financial system and deserved their losses. The more complex truth, that they were ideological investors who'd made catastrophic errors in execution rather than malicious criminals, was lost in the sensationalism. Chapter 8. Legal Aftermath. The legal consequences of the Silver Corner extended far beyond the Hunt brothers. Multiple lawsuits were filed by investors who'd lost money during the silver crash. Short sellers who'd been squeezed sued for damages. Industrial users who'd paid inflated prices sued. Other traders who'd been caught in the volatility sued. The litigation lasted for years and cost tens of millions in legal fees and settlements. One of the most significant cases was brought by a Peruvian mining company that had sold silver futures at low prices, expecting to cover with future mine production. When silver prices exploded, the company faced massive losses. They sued the Hunt brothers for market manipulation and eventually won a significant settlement. Minpico SA versus Hunt, filed in 1981, became the landmark civil case. Minpico alleged the Hunt brothers had conspired with Middle Eastern investors to corner the silver market, causing Minpico to suffer losses on its hedging contracts. The case went to trial in 1988. The trial was a media spectacle. Bunker Hunt testified for days, defending his silver investment strategy. Prosecutors presented evidence of coordinated trading between Hunt family accounts and IMIC positions. Financial experts explained how the corner had distorted markets. The jury found against the Hunt brothers. They were ordered to pay Minpico $134 million in damages, later increased to over $200 million with interest and legal fees. It was one of the largest commodity market manipulation verdicts in history. But the most important legal legacy was regulatory. Reformed the Commodity Futures Trading Commission, used the silver corner as justification for expanded regulatory authority. Congress passed legislation strengthening the CFTC's enforcement powers, increasing position limits, and giving exchanges more tools to prevent market manipulation. The reforms focused on several key areas. Position limits. The new regulations set strict limits on how many futures contracts any individual or group of related traders could control. These limits applied across all accounts and required traders to aggregate positions of related parties. The loophole the Hunt brothers had exploited, using multiple accounts to stay below individual limits, was closed. Concentrated position reporting. Exchanges were required to monitor and report large positions to regulators in real time. If any trader or group approached concerning concentration levels, regulators would investigate immediately rather than waiting for prices to become disruptive. Emergency powers. Exchanges gained explicit authority to change margin requirements, impose position limits, or restrict trading in emergency situations without lengthy approval processes. This prevented the situation where exchanges knew a corner was developing but lacked clear authority to act quickly. Anti-manipulation rules. The legal definition of market manipulation was clarified to include coordinated action by multiple parties acting in concert, even if they weren't formally partnered. This closed the loophole where the Hunt brothers claimed they weren't coordinating with IMIC despite obvious trading pattern correlations. These reforms fundamentally changed how commodity markets operated. The freewheeling environment of the 1970s, where wealthy individuals could attempt market corners with relatively little regulatory oversight, ended. Look, the regulatory response was controversial. Free market advocates argued the reforms restricted legitimate investing and protected weak traders from their own bad decisions. They pointed out that short sellers who'd bet against silver had made risky speculative bets and deserved to lose. When they were wrong, the counter-argument was that commodity markets serve essential economic functions. Farmers need to hedge crop prices. Manufacturers need to secure supply costs. Airlines need to lock in fuel prices. These hedging functions require liquid, stable markets. If markets can be cornered by wealthy speculators, the entire system breaks down. The Hunt brothers' silver corner had proven that unchecked speculation could threaten these essential market functions. The reforms were designed to prevent that from happening again. International coordination. The silver corner also revealed gaps in international commodity market regulation. The Hunt brothers had used offshore entities and foreign exchanges to build positions that weren't fully visible to US regulators. IMIC operated from Bermuda. Silver was traded in London, Zurich, and Hong Kong, as well as New York and Chicago. After Silver Thursday, regulators from major financial centers began coordinating oversight. They shared information about large positions. They harmonized some rules to prevent regulatory arbitrage. The goal was to make it harder for traders to exploit gaps between different jurisdictions. This International coordination was imperfect. Sovereignty concerns limited how much countries would defer to foreign regulators, but it represented a significant shift toward viewing commodity markets as global. Systems requiring coordinated oversight. Brokerage firm reforms. The near failure of Bach and Coasters exposed how brokerage firms' credit risk could threaten financial stability. If Bach had collapsed, it would have triggered panic across Wall Street. Client accounts would have been frozen. Other brokers with exposure to Bach would have suffered losses. A cascade of failures was possible. Regulators responded by strengthening capital requirements for brokerage firms. Brokers had to maintain larger reserves relative to the credit they extended. They had to stress test their exposure to large clients. They had to report concentrated credit exposures to regulators. These reforms made the financial system more resilient, but also more expensive to operate. Smaller brokers struggled with the increased capital requirements. Some were acquired by larger firms. The industry consolidated. The Hunt brothers' personal aftermath. Both Bunker and Herbert Hunt emerged from bankruptcy in the early 1990s, but their lives were forever changed. Herbert Hunt lived quietly in Dallas, managing small oil and gas investments. He avoided publicity and rarely discussed the silver episode. He maintained relationships with remaining family friends, but found that many business associates had distanced themselves after the bankruptcy. The social circles that had once welcomed the Hunt brothers now treated them with awkward sympathy or outright avoidance. Herbert died in 2014 at age 85, having rebuilt modest wealth but never approaching his former fortune. Bunker Hunt was more defiant. He gave occasional interviews defending his silver investment and criticizing government intervention in markets. He remained convinced that his fundamental analysis had been correct and that regulatory manipulation had destroyed a legitimate investment strategy. In a 1988 interview with Fortune magazine, Bunker famously said, "$1 billion isn't what it used to be." The comment was meant as a joke about inflation, but it revealed his disconnect from ordinary financial reality. Even in bankruptcy, Bunker Hunt thought in terms of billions. He spent his later years on a modest ranch in Dallas, raising cattle and horses, though nothing approaching the thoroughbred operation he'd once owned. He would occasionally speak at libertarian conferences, where he was treated as a martyr to government overreach rather than a failed speculator. He died in 2014 at age 88. Neither brother ever fully recovered their wealth. The empire H.L. Hunt had built, and which they'd expanded with the Libyan oil fields, was gone. The Hunt family remained wealthy by ordinary standards, but was no longer among America's richest families. The ripple effects on other players. The Hunt brothers weren't the only casualties of the Silver Corner collapse. Several smaller brokerage firms that had extended credit to silver speculators failed in 1980. These weren't household names like Bache or Merrill Lynch, but they were established firms with decades of history. When silver crashed, their heavily leveraged clients defaulted. The firms lacked the capital reserves to absorb the losses. They went bankrupt. Thousands of individual investors lost money. Many were dentists, doctors, and small business owners who'd been attracted by silver's spectacular rise. They bought silver coins, small bars, or futures contracts, believing the rally would continue. When prices crashed, they suffered losses that wiped out years of savings. One particularly tragic case involved a California dentist who'd mortgaged his home and dental practice to buy silver at $40 per ounce. When prices fell to $10, he lost everything: his home, his business, his marriage. He filed for bankruptcy and spent years rebuilding his life. His story was replicated thousands of times across America. The Middle Eastern investors in IMIC also suffered substantial losses, though they were generally wealthy enough to absorb them. Prince Faisal Al Sabah of Kuwait lost an estimated $200 million. Saudi businessman Mahmoud Fustok faced similar losses. These were enormous sums, but not life-destroying for members of oil-rich royal families. What's interesting is that the Middle Eastern investors largely avoided legal consequences. They were foreign nationals operating through offshore entities. US regulators had limited jurisdiction. While the Hunt brothers faced years of litigation and criminal charges, their Middle Eastern partners quietly exited their positions and moved on. The media narrative The way the silver corner was covered by media evolved significantly over time. Initially, in late 1979 and early 1980, coverage focused on silver's spectacular price rise. Business magazines ran cover stories about precious metals as inflation hedges. Financial talk shows featured experts predicting $100 silver. The Hunt brothers were portrayed as savvy investors who'd correctly anticipated monetary chaos. After Silver Thursday, the narrative flipped completely. The Hunt brothers became greedy manipulators who'd nearly crashed the financial system. Journalists dug into their business history, their political views, and their family dynamics. Investigative pieces revealed the coordination with IMIC and the scale of their borrowing. By the mid-1980s, as legal cases proceeded, coverage became more analytical. Business historians examined the silver corner in the context of previous market manipulations. Economists debated what the episode revealed about market efficiency, speculation, and regulation. Time magazine's 1980 cover story called The Hunt Brothers, the Silver Kings Who Lost Their Crowns. The New York Times published lengthy investigations into how the corner was executed and why it failed. Forbes ran profiles exploring the psychological factors that drove Bunker Hunt's obsession. This media coverage shaped public perception. The Hunt brothers entered American cultural consciousness as cautionary figures, symbols of hubris, greed, and the dangers of fighting market forces. Academic studies and economic research. Silver Thursday became a rich subject for academic research across multiple disciplines. Finance professors studied the mechanics of the corner, how leverage amplified both gains and losses, how regulatory intervention affected price discovery, how systemic risk propagated through connected institutions. The episode provided real-world data about extreme market events that were rare in financial history. Business school case studies dissected the Hunt brothers' decision-making. What psychological factors led them to escalate their positions even as risks mounted? How did group dynamics between Bunker and Herbert influence their strategy? What role did ideology play in overriding pragmatic risk management? Legal scholars examined the regulatory response. Were the rule changes justified as emergency measures to prevent systemic collapse? Or did they constitute inappropriate government intervention that punished successful investors to protect losing short sellers? The debate touched on fundamental questions about market regulation and property rights. Economic historians placed the silver corner in a longer context of commodity market manipulation attempts. They compared it to the eerie railroad wars of the 1860s, the Northern Pacific corner of 1901, and the famous wheat corners of the early 20th century. Silver Thursday represented a culmination of this tradition, likely the last great commodity corner possible in modern regulated markets. One influential 1985 academic paper by economists at MIT concluded that the Hunt brothers' silver corner was rational, given their beliefs about monetary collapse, but catastrophically wrong due to excessive leverage and failure to anticipate regulatory response. This balanced assessment captured the complexity. The Hunts weren't simply foolish, but they made critical errors that destroyed an otherwise potentially successful strategy. The psychological dimension. Understanding why the Hunt brothers persisted in their silver strategy, even as warning signs mounted, requires examining psychological factors. Bunker Hunt exhibited classic signs of what behavioral economists call commitment escalation, the tendency to increase investment in a failing strategy to avoid admitting error. Each time silver prices rose, it reinforced his conviction. When prices fell, he interpreted it as temporary manipulation that vindicated his decision to hold. The Libyan nationalization had created a psychological scar. Bunker Hunt had built something extraordinary in Libya, a major oil field that generated enormous wealth. Then a foreign government confiscated it. This experience created deep distrust of institutions, governments, and paper assets. Silver represented control. Physical metal in a vault couldn't be nationalized by decree or inflated away by central bank policy. For Bunker, silver wasn't just an investment. It was insurance against the kind of institutional betrayal he'd experienced in Libya. Herbert Hunt's psychology was different. He was more risk-averse and practical. But he was also loyal to his brother and deferential to Bunker's stronger personality. Herbert repeatedly expressed concerns about leverage and concentration risk, but he ultimately went along with Bunker's strategy. This family dynamic, one dominant visionary brother and one cautious but loyal supporter, created a decision-making structure that lacked effective checks. Confirmation bias played a major role. The Hunt brothers sought information that confirmed their thesis about monetary collapse and silver's value. They hired consultants who shared their views. They read publications that reinforced their ideology. They surrounded themselves with yes-men rather than skeptics who might challenge their assumptions. There's also an element of hubris. The Hunt brothers had succeeded spectacularly with the Libyan oil fields. They'd proven they could identify opportunities that others missed. This success bred overconfidence. If they could be right about Libyan oil, why wouldn't they be right about silver? What they failed to recognize was that oil field development and commodity market manipulation are fundamentally different. Oil fields reward patient capital and geological expertise. Commodity corners require anticipating regulatory responses, managing counterparty relationships, and recognizing when to exit. The skills aren't transferable. The counterfactual, what if they'd succeeded? It's worth considering what would have happened if the Hunt brothers had actually succeeded in sustaining their silver corner. Imagine COMEX hadn't changed the rules. Imagine silver stayed at $50 through 1980 and rose to $75 or $100 in 1981. Imagine the Hunt brothers maintained their position and industrial users were forced to negotiate with them for silver supply. The economic consequences would have been severe. The jewelry industry would have collapsed. Most jewelers couldn't operate profitably with silver at those prices. Photography companies would have accelerated the transition to alternative processes, potentially disrupting the entire imaging industry years earlier. Electronics manufacturers would have redesigned products to minimize silver content, reducing long-term demand. But here's what's crucial. Even in this scenario, the corner would have eventually broken. High prices would have stimulated massive new mine production. Every old mine in the world would have restarted operations. Explorers would have sought new silver deposits. Within a few years, supply would have flooded the market. Meanwhile, demand would have cratered. Jewelry consumption would have fallen 80%. Industrial users would have found substitutes. Investment demand would have waned once prices stabilized. The fundamental economics would have reasserted themselves. When the corner finally broke, whether in 1981, 1982, or 1983, the collapse would have been even more catastrophic. The Hunt brothers would have been even more leveraged. Prices would have fallen from even higher levels. The systemic risks would have been greater. So in a perverse way, Silver Thursday saved the Hunt brothers from something worse. The regulatory intervention forced a reckoning when there was still a possibility of survival. Delay would have meant total destruction. Legacy and popular culture. The Hunt brothers' silver corner entered popular culture in unexpected ways. The 1983 film Trading Places featured a subplot about commodity market manipulation, though focused on frozen orange juice, futures rather than silver. The film's climax involves the protagonists engineering a market corner and bankrupting the villains. Many viewers and critics noted the parallel to the Hunt brothers' recent failure. Business books throughout the 1980s and 1990s referenced Silver Thursday as a cautionary tale. Investment guides warned against excessive leverage. Trading manuals explained short squeezes using the silver corner as the definitive example. Self-help books for entrepreneurs cited the Hunt brothers as warnings against letting ideology override pragmatism. In Texas, the Hunt family's fall became a local legend. Dallas society, which had once courted the Hunts as elite members, treated their bankruptcy as a scandalous decline. Country clubs where Bunker and Herbert had been prominent members saw them resign or withdraw. The social consequences were as devastating as the financial ones. Bunker Hunt's famous quote, "$1 billion isn't what it used to be," became a punchline. Late-night comedians used it to mock the rich. Editorial cartoonists depicted the Hunt brothers drowning in silver coins. The cultural moment had turned against them completely. The final accounting. When all the lawsuits were settled, all the assets liquidated, and all the debts repaid, what remained of the Hunt brothers' silver adventure? They'd accumulated approximately 200 million ounces of silver at an average cost of roughly $10 per ounce, a total investment of $2 billion. At the peak in January 1980, their position was worth $10 billion. They'd created $8 billion in paper profits, but they'd also borrowed approximately $1.5 billion to finance their positions. When silver crashed to $10, their physical holdings were worth only what they'd paid. The leverage that had amplified their gains on the way up destroyed them on the way down. After forced liquidation, bankruptcy proceedings, legal settlements, and fire sale asset disposals, the Hunt brothers had lost an estimated $5 billion in wealth. Some was actual cash losses from repaying debts at unfavorable terms. Much was the opportunity cost of selling assets at depressed prices to raise emergency cash. The banks that bailed them out in March 1980 eventually recovered most of their money by seizing and selling Hunt assets over several years. But even the banks suffered losses on the emergency loans, estimated at $200–300 million collectively. The broader economy suffered too. Small investors lost billions. Brokerage firms absorbed hundreds of millions in losses. Industrial companies faced disrupted supply chains and volatile input costs. The total economic damage from the silver corner was impossible to calculate precisely, but likely exceeded $10 billion. For what? The Hunt brothers wanted to prove a point about monetary policy. They wanted to protect their wealth from inflation. They wanted to exercise power over a commodity market. In the end, they proved only that markets are bigger than any individual, and that ideology is a poor substitute for pragmatic risk management. The Silver Corner, conceived as a grand strategy to preserve wealth and vindicate a monetary philosophy, became instead the mechanism of the Hunt family's destruction. Here's a lesson that echoes through financial history. The market always wins. So we've seen how two Texas oilmen almost broke the global silver market, how they exploited regulatory loopholes to accumulate unprecedented positions, how they recruited Middle Eastern wealth to amplify their corner, and how their spectacular failure on Silver Thursday nearly brought down the American financial system. The Hunt brothers' Silver Corner lasted roughly 18 months from serious escalation to catastrophic collapse. In that brief period, they demonstrated both the possibilities and the limits of individual power in modern financial markets. Today, more than 4 decades after Silver Thursday, the episode remains the definitive case study in commodity market manipulation. Business schools teach it, regulators reference it, traders remember it. The Hunt brothers' names became synonymous with the dangers of hubris, leverage, and fighting the system. But when you step back and look at the full picture, the story is more nuanced than simple greed or stupidity. The Hunt brothers weren't fools. Bunker Hunt had already proven his investment acumen with the Libyan oil fields, one of the most successful petroleum discoveries in history. He'd demonstrated patience, analytical skill, and willingness to take contrarian positions. These are typically virtues in investing. Their fundamental analysis of silver wasn't entirely wrong either. Industrial demand was growing. Above-ground supplies were declining. Government monetary policy was inflationary. In that environment, hard assets did outperform. Gold rose from $35 to $800. Even after the crash, silver settled around 5 times its early 1970s price. What destroyed the Hunt brothers wasn't their analysis. It was their execution and their psychology. They crossed the line from investing to manipulation. They used excessive leverage that turned a profitable position into a catastrophic liability when prices reversed. They became ideological rather than pragmatic, holding positions based on conviction rather than adjusting to market realities. And they underestimated the power of regulators and exchanges to change rules when systemic stability was threatened. The real lesson here isn't that commodity investing is inherently dangerous. It's that attempting to corner markets, to control supply and dictate prices, inevitably triggers responses that destroy the corner. The Hunt brothers forgot that markets are ecosystems, not machines they could control through sheer wealth. Consider the different outcome if they'd approached silver differently. Buy 50 million ounces at $2 to $3 per ounce. Store it, wait. When prices rose to $30 or $40, sell half to lock in profits. Hold the rest as a long-term inflation hedge. This conservative approach would have generated enormous returns without triggering the regulatory backlash that destroyed them. But that wasn't enough for Bunker Hunt. He didn't just want returns. He wanted vindication of his monetary philosophy. He wanted to prove that hard assets were superior to government fiat currency. He wanted to control a commodity market and demonstrate the power of that control. This psychological dimension is critical. The Hunt brothers' silver corner wasn't just about money. It was about ideology, about proving a point, about exercising power. And that emotional investment made them inflexible when circumstances demanded adaptation. Whether we like it or not, their failure ultimately strengthened commodity markets. The regulatory reforms that followed Silver Thursday made manipulation harder. Position limits, reporting requirements, emergency exchange powers. These safeguards protect the hedging and price discovery functions that make commodity markets valuable to the real economy. Yes, the reforms restrict some legitimate investment strategies. Yes, they protect short sellers from squeezes, but they also prevent wealthy individuals from destabilizing critical commodity markets and threatening financial system stability. The modern silver market, small, less industrially critical, more tightly regulated, would be nearly impossible to corner today. The Hunt brothers' attempt and spectacular failure closed that door, probably forever. There's a question that remains. What if the regulators hadn't intervened? What if COMEX hadn't changed margin requirements and imposed Silver Rule 7? Would the Hunt brothers' corner have succeeded? Possibly, briefly. Silver might have stayed at $50 or climbed to 75 eyes or even $100. The short squeeze might have continued for months. Industrial users would have been devastated. The Hunt brothers would have made billions more in paper profits, but eventually the corner would have broken anyway. Demand destruction at high prices was already occurring. New mine supply was ramping up. Alternative materials were being adopted. The fundamental economics of silver at $50, $100 per ounce weren't sustainable, and when the corner eventually broke, whether from market forces or delayed regulatory intervention, the EUB collapse would have been even more catastrophic. More debt, more leverage, higher prices to fall from, larger systemic risks. In that sense, Silver Thursday might have saved the Hunt brothers from an even worse outcome. The regulatory intervention forced the collapse when the Hunt brothers still had assets to liquidate and banks willing to provide bailout loans. 6 months later, with even more leverage and higher prices, they might have faced complete personal bankruptcy with no recovery possible. So the question remains, were the Hunt brothers visionary investors persecuted by establishment forces? Or were they reckless manipulators who got what they deserved? The answer is probably both. They were visionary enough to identify silver's potential, reckless enough to attempt an impossible corner, wealthy enough to nearly pull it off, and human enough to be destroyed by their own hubris. Their story is a reminder that in financial markets being right isn't enough. You have to be right about timing, risk management, leverage, and the limits of your power. The Hunt brothers got the analysis right and everything else wrong. That's why 4 decades later, we still talk about Silver Thursday. If you made it through this entire deep dive into one of history's most spectacular financial collapses, and you're still with me, drop a E in the comments. This story fascinates me because it's not just about money. It's about ideology, family legacy, and what happens when conviction becomes obsession. The Hunt brothers genuinely believed they were protecting their wealth and proving a point about monetary policy. Instead, they lost everything. If you found this video valuable, subscribe to the channel. We go deep on stories like this: financial disasters, business empires, historical economic events that shaped the modern world. No surface-level coverage, just thorough research and comprehensive storytelling. I've got another video you might enjoy about the long-term capital management collapse in 1998, another case where brilliant people used excessive leverage and nearly broke the financial system. The parallels to Silver Thursday are striking. That video breaks down how Nobel Prize-winning economists lost $4.6 billion in 4 months. Check it out. The link is in the description. Here's my question for you. Do you think the Hunt brothers were treated fairly? Were they victims of regulatory overreach? Or did they get what was coming to them for trying to manipulate markets? The debate continues among economists and investors today. Let me know your thoughts in the comments. Thanks for watching. I'll see you in the next deep dive.